Welcome back to Investment 360. We're back with Glenn Silverman, the Chief Investment Officer of Investment Solutions. We've been talking about the history, the situation that India finds itself in, and now we'd like to get a little bit more into the financial markets and the opportunities for investors. You've gone over there, I guess, quite an in-depth fact-finding mission to ascertain and get a feel for what's going on in the economy. Tell us a little bit about the history of the Indian stock market relative to the history that you've painted of the country in the first half of the interview.
I think maybe just was a little bit of background which leads us to the stock market. Is also, if we have a look at the last 50 years of British rule up until independence in 1947, the economy in India grew broadly at 1%. From then until 1991, which was a really, really critical year in their history, it grew between 3 and 5%. So much stronger growth under independence, 1947 to 91. In 1991, India nearly defaulted. They were within weeks, if not days, of going to the IMF to bail them out, etc. And they had to reform the economy. So they say that India only reforms in crisis, and 1991 was therefore a great opportunity to them. They removed this license Raj. They stopped nationalizing and they started to privatize, etc. And from then we saw Indian growth start to reach between 5 and 7%, at times almost approaching the 10% type of mark, not so far off China. So we've seen since 1991 a much freer economy, and we've seen the benefits of that kind of coming through as well. If we look at the stock market specifically, the Bombay Stock Exchange has something like 5,300 listed companies. JSE is sitting at 400 to 500. So dramatically more companies available, and you see it everywhere. There are literally tens of thousands of small and medium enterprises, some of them becoming larger, some of them listing, etc. So I think a wonderful opportunity to stock pickers in that country.
You mentioned though that in terms of the liquidity, the market doesn't trade as high as the JSE. There are some big Indian names, Tata is one of them, that are big by global standards, but have they got enough of the really big companies to drive liquidity and investment into that stock exchange specifically?
Well, I'm not 100% sure. I haven't tried to analyze exactly why it is that, for example, I think South Africa's market trades something like 3 times as much on an annual basis. The Brazilian stock market, the Bovespa, 8 times as much as the Indian market. So you have a lot more liquidity, bigger companies, etc. I guess it's part of the development there. They also have some kind of forms of exchange control in the country, so quite difficult still for foreigners to get into that market. As that tends to relax, I tend to think we will see an uplift in terms of liquidity, etc. But the one stat which was absolutely fascinating to me, and a very strong investment theme that comes out of this, is the number of 10 baggers that we saw in India. In other words, shares that have gone up tenfold. That number was, in the last 10 years, was higher in India than any other country in the world. The next highest, and there were 750 of those companies. Next highest was Korea at 72. So wonderful opportunities to those people who can actually find the gems.
720 10 baggers, I think that would make any fund manager lick his chops through with interest there. What's the sort of opportunity now for specifically your clients and investment solutions? How do you start approaching BRICS and especially the markets that you're excited about, like India, with regards to making a presence in your portfolio?
So I think it's a very, very good question, and one can approach this differently. And I guess the size of assets that you have under management and the flexibility you have makes quite a big difference. Our approach has been the following. We pick managers with a global equity mandate. That means they can pick shares based anywhere in the world. So we haven't gone for a regional approach. We haven't said we've got X% in China, India, Brazil, and North America, etc. We have had that approach in the past. It's very complicated. Who decides how much? You often have countries that have wonderful stories behind them. The Indian story is a very good story. What about valuations? What about whether it's already all priced in, etc. So our approach has been to very much go for global equity managers. However, what we found is those managers, and they're very good managers based in Edinburgh and London, New York in the main, tend to buy British, French, and American shares in the main. There's very little direct exposure to these up-and-coming 10 baggers, those themes. And so what we did last year is we changed our benchmark away from MSCI World to the MSCI all countries. And what that means, instead of having 0 in emerging markets, our benchmark now has 13%. But since our managers don't own 13%, we put a passive component in to close out that gap. So we're neutral to that 13%, and we are now in a process of going to find global emerging market managers to replace it. We want active managers in the space, more than this space than any other, because you can find 10 baggers and other things. So that is the exercise that's underway.
And I'm interested to find out here, what's the experience been with investment solutions with regards to those investment managers that you will use in a place as specialized and complex as India? Do you favor using a in-country manager there that would be a local Indian investment manager, or do you favor using specialists that are outside, but then you've got to really pay attention to the mandate because you might not get that exposure that you want?
Yeah, we think increasingly the world is a very complex place. We don't have the ability nor the desire to go and find regional managers in all different parts of the world. One for Bangladesh and one for Indonesia, and one for India, and one for China, etc. So we are only looking at guys who have a global emerging market portfolio. Now, if they choose because they see the opportunities either top down or bottom up in India and have a big weighting there, fantastic. And if they feel not, then as long as we rate them highly as a good manager, I'm very comfortable. So we certainly will not insist that they have to take any particular. And again, Brazil, we came back with a very positive view on the country, deep resources, etc. The stock market has done terribly. So, you've got to be very, very cautious. Our approach, therefore, is going to pick these global emerging market managers and let them decide where they wish to. But there's a difference. At least picking an emerging market manager, they will buy emerging market stocks. If you give it to a global equity manager, they may or may not do that. They'll buy a lot of Nestle with the argument that Nestle sells into these countries, but you may not get the direct exposure.
Glenn, the capital centers in the world, the New York, London, Singapore, Hong Kong, very English-speaking, English-dominated. Does the fact that a fund manager can pick up an annual report in English in India make it any more attractive or easier for him to invest there than perhaps going to a place like Brazil?
I think it does. I think it would make sense that it would. The common business language in the world certainly is English, and I think there's an advantage to that. I mean, I'd certainly, for example, contrast that maybe to a Chinese annual report written in Mandarin. That might be a hell of a lot more difficult for any kind of global investor to have a look at. But guys who are running global equity portfolios or global emerging market portfolios have to deal with these complexities. One gets a sense they travel quite extensively. They often have those nationals within their team. So they have a Mandarin-speaking person in the team or Portuguese-speaking, et cetera, et cetera. So, good global managers are going to have to deal with the complexities of this world.
Just in terms of that, and just to maybe move the discussion a little bit sideways here and just look at the South African investment industry, obviously you're very, very familiar with it. We've seen one or two companies really starting to open their offerings up and become, as for instance, at the Coronation, a specific emerging market fund has been launched there, and it's been run very well. Investec has gone more into developed markets. Do you think that there's an opportunity for our investment managers to broaden their horizon a little bit? And are you seeing that?
Yeah, definitely. So we're certainly seeing, it's interesting, we're seeing certain managers niching their businesses a lot more. I just returned from seeing all the major CEOs and COOs of major asset managers 2 weeks ago in Cape Town. There's small houses, a Taquanta, a relatively unknown house that focuses very much in the money market space, 70-odd billion under management. That's not, that's big money. That's kind of the Investec strategy, which I think actually is much more centered on emerging markets, and in particular now frontier markets. Again, quite excited about the more esoteric space. And you're right, Coronation running a very successful emerging market portfolio. So actually we're seeing managers doing all. Some are going much more global, some are being much more niched, some are finding great opportunities in fixed income space, others in kind of global equity, local equity, and actually quite a lot in pushing hard in the unlisted space as well.
And I know certainly in Africa that's one of the focuses. We've heard John Oliphant talking about using private equity to access some of the unlisted companies that are operating on the continent. In terms of the strategy now, if you tie that in, I think you said that you've got about a 13% exposure directly through to emerging markets, and you use passive strategies to top that up. Does that get you to around 30% of the portfolio in your equity mandates now in emerging markets?
No, so what it would have done is our managers probably are about 5% naturally exposed, so we topped that up to 13, so we added another 8% passive. But that passive is going to go. We will replace in the next few months by an active strategy. Coronation is one of the managers we're considering, but we actually have a lineup. There are about 30 managers we've seen globally. The team in London has been spending a lot of time with them. I leave in April for a trip to see a whole lot of managers with quite a big team. There's 5 of us going, and we're going to come back and hopefully conclude in who we're giving the money to.
Okay, great. Just I think just then to tie it in for a retail investor, how do they think about this? I mean, obviously they might be invested in investment solutions, fund of funds. How should a retail investor, when he's looking at his portfolio, think about an emerging market exposure?
Yeah, you know, I keep wondering whether there's a holy grail in what we do, and the answer is there isn't. You know, there's approaches that work at different periods of time. I met an individual this last weekend who is a very wealthy individual and travels to India and spends 3 or 4 weeks there and can meet individual companies. To that guy, he can go and buy individual shares within India. To others, they might want to look at some of the kind of regional, if you really like the Indian theme, for example, find managers locally and globally. There are a lot of them that run Indian portfolios. To me, that's very complicated, and there'll be a very small proportion of retail investors who can do it. If they invest in our portfolios, we're taking care of that. We've set a strategy that incorporates this, that I think is sensible, which is very global. We're managers who I think are the best positioned to make the calls. Do I want to be in this region, in this sector, in this company, can make that call or not? And to the rest, maybe, you know, stick with, you know, the big global equity portfolios and let those managers gain exposure in a more diversified fashion. It's been a very successful way to manage money. Again, I don't pick on Nestle or Unilevers or the Procters & Gambles, but that hasn't been a bad strategy as well. There's a hell of a well-run companies with very strong brands and strong cash flows, and if they are gaining the exposure, let them deal with the currency turmoil and the politics that does come with the emerging market exposure, etc. So I would say, as long as you understand your strategy, I think actually all have merit.
Okay, great. Glenn, we're going to have to leave it there, and thanks again for your time.